There is a ton to talk about today. There's the whole January 6th FBI connection that Tucker broke last night. There's the Biden-Putin summit, which I would love to talk about. But ultimately, what I'm going to pick is what I think will go the most underreported and the least discussed, and that is today is yet again Fed Day. Jerome Powell held a press conference on behalf of the meeting of the Fed Open Market Committee. The committee put out a statement where they like to manage market expectations, and they have their little terms that they barely change from month to month. Frankly, I mean, it's kind of funny that they even write it in paragraph form these days, because the FOMC statements are just sort of a checklist of different terms, and they very sort of methodically turn terms on and off and adjust things, and they play this game like they're giving their opinion, when it really is they're just listing a bunch of variables. The FOMC statement is it's written in code, but everybody knows what the code is. And so it doesn't. It's another example of what a sham our financial system is. And so every time there's a meeting, Powell comes out and he stands before the clapping seals, known as the financial press, who bow at his feet and and kiss his ring and say, "Oh, gee, sir, please let me ask a question." Nothing ever too challenging. If there is one challenging question, then Powell, will just sort of trail off and say whatever he wants, and there will be no follow-up, and that guy probably will never get to ask another question for the rest of his life. And I guess today I'll start with the question that came last at today's press conference, because it seemed to be the most interesting one. The question itself didn't interest me much at all, but Powell's reaction to it sure did. Powell got very flustered, and what he was asked was basically that Powell says now that they are data dependent over at the Fed, meaning that they're not going to raise rates because they think that inflation is going to go up or something like that. They need to wait for data. They need to see what's happened in the past and react in real time. And as of right now, as of last week, we see CPI is at 5%, producer price index is at 6% And so if you're really data dependent, Chairman Powell, shouldn't you be trying to tighten monetary policy right now? Not keep it loose if you're supposedly data dependent, because now you're relying on forecasts to say that, oh, inflation's transitory, we promise. That's what we forecast, even though right now there is inflation. If you're data dependent, shouldn't you be trying to roll back your expansionary monetary policy right now? And when inflation gets down, to where you wanted it, then you can try and expand again or something like that. And Powell just got so flustered he couldn't answer. He gave no question. He just he repeated his talking points and said, I stand by what we say, and we make good decisions here, and we know what we're doing. And I mean, the guy is just he's no Greenspan. I'll put it that way. Powell is not. He's not a deep guy. He doesn't know how to riff on any of this stuff. I think that he buys into his own BS a little too much. And because there's no logic behind it, it's difficult for him to try and justify these things, because it's not so much that he doesn't believe in what he's saying, it's that he doesn't have a very deep understanding of what it is he is saying. So he might believe that very strongly. He might be very opinionated and think, no, I'm doing the right thing. But he doesn't really understand what he's doing. And that's why, people lash out when they lack knowledge. People get angry or fearful when they don't understand the situation, when they're when they're uncomfortable. That's when they don't know what's going on. Either that, or Powell just knows that He can't ever cut. He needs to keep printing money in order to sustain the current bubble that was blown by Janet Yellen mostly, and that he inherited, that he has continued to inflate, that he has inflated to highs never before seen in American history. This is the greatest bubble by 2 orders of magnitude ever, in the words of Michael Burry. And so Powell can't just say, I don't want to pop the bubble, because he can't admit that there's a bubble. It's one of those games that Fed chairmen like to play. It's never a bubble. It's always good, healthy growth. And that's what justifies them continuing to print money. Now, something interesting to come out of these meetings, but never anything that ends up having much meaning, is the dot plot. And the dot plot is a chart. It is a dot plot chart of where each member of the Fed Open Market Committee thinks interest rates will be, the Fed funds rate, which is currently at 0, where they think that rate will be at some point in the future. And the dot plot showed that I believe the median consensus amongst the committee was for there to be 2 rate hikes in 2023, which, for those of you unaware, that's 2 years away. So they're saying in 2 years, maybe the Fed funds rate could jump to 0.5%. That's what we're talking about here. And on that news, stocks sold off about 1%. It was a little bit of a blip. Didn't really matter. I don't think that there was really any reason for stocks to sell off based on that alone. A rate hike in 2 years, who cares? Doesn't really have much bearing on current reality. I'm sure the bubble will get much larger if all that changes. If everything stays the same for the next 2 years and all that happens is there's 2 rate hikes in 2023, the bubble's going to be much, much higher by the end of 2022. I guarantee you that. But it was interesting. We saw this, it's hard to even call it a sell-off, this little blip to the downside, this down tick in the stock market. And Powell comes out, and he just can't help. He can't help himself. He comes out and he just starts slamming the dot plot and saying the dot plot doesn't matter. Don't pay attention to it. Doesn't mean anything. It's useless. The dot plot has no value. Don't pay no attention to the dot plot on the paper. And then, of course, the stock market magically recovered. And, I didn't think much of it, because this is typical. Powell always says, oh, don't pay attention to the dot plot. We'll never raise interest rates. That's what he's trying to say. I've been saying that for years. 3 years now. Close to 3 years. 2.5 years, I guess I've been saying that. Powell's not going to raise rates. He will put the kibosh on that. He will veto any rate hikes. And so if the dot plot ever signals any kind of rate hike at any point in the future, you can be assured that it doesn't matter. Now, on to the next, the only other interesting question that there was to come out of this was that there was a guy, Greg, was it, from MarketWatch, who I believe asked a good question at the last Powell press conference, so good on him getting in. Maybe that guy's somewhat decent. Greg something at MarketWatch. I should look him up later. He asked that, Chairman Powell, next year, the forecast is that economic growth is going to be slower than it is this year. Economic growth will be decelerating, and inflation will remain, or I can't remember exact words, but something about to the extent of, hey, next year growth's going to be slowing and inflation is going to be high. Doesn't that at all concern you? Doesn't that at all make you scratch your head and think, maybe we should be watching out for stagflation? And, it was a very good question, because that is exactly what the Fed should be worried about, because that is what the Fed is essentially creating. And Powell, of course, almost completely ignored the question, gave no real answer to it. He just resorted back to his talking points and said something about blah, 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 or I can't remember his stupid language that they keep using. Substantial further progress, that's what it is. Whatever substantial further progress means. And he didn't really define whatever substantial further progress means. You know, he said it's whatever we say it is. And towards the end, well, I guess I'll talk about, I get the biggest news that came out of this was that Powell said that they talked about talking about tapering at this meeting. They didn't talk about raising rates. That's years and years and years in the future. That's nowhere in the ballpark. Never think about raising rates. It's not going to happen. Powell made it clear. But he said today they talked about talking about tapering, which means at some point in the future they're going to actually talk about tapering. It's going to be a real possibility. Now that doesn't mean that there's going to be tapering after the next meeting. I think almost guaranteed that would not happen. You're going to hear talk, and Powell said this, that they're going to signal it far in advance. So you're going to hear a lot of talk about tapering and jawboning before they ever actually taper. And by taper, for those of you unfamiliar who somehow have made it 11 minutes into this rant of mine about the Fed and don't know what tapering refers to, tapering of asset purchases meaning reducing QE, quantitative easing. Quantitative easing is when the Fed creates money out of thin air and then goes into the bond market and buys U.S. Treasury bonds and mortgage-backed securities, helping to inflate the housing market and monetize the budget deficits of the federal government and finance this limitless deficit spending, which has occurred mostly over my lifetime. I believe, around the time I was born, in the late 90s, the U.S. Federal debt was less than $1 trillion. And ever since then, it's been blown up to almost $30 trillion. We've had many years where the annual budget deficit, the amount of debt accumulated in a single calendar year, single fiscal year, I should say, was greater than the national debt was at its lowest point in my lifetime. And that has been enabled largely by quantitative easing, the policy of the Fed, where they go into the market and they buy up federal debt. What the federal government can't spend for lack of tax dollars, they are able to spend by virtue of the Fed printing the money and handing it to them. So I guess the only real takeaway from today's meeting, or from today's press conference, which was very underwhelming and, it gives you that sick feeling in the bottom of your stomach that Fed press conferences typically do. There was no real excitement. There was no balance sheet runoff is on autopilot kind of comment, but the closest thing we got to that was that tapering is going to be on the table at some point, and that QE might be slowing. It's not coming to an end anytime soon, but it might begin to slow by the end of this year. They might, in Q4, start to taper somewhat. And that is significant. I guess I should have led with this, but we are not in a state in this economy, in this market, to where we can sustain the bubble without quantitative easing or with reduced quantitative easing. Tapering will, even without rate hikes, tapering by itself will prick the bubble. And I know the folks who have been, who maybe have been reading Zero Hedge over the past few weeks will say, but tapering is bullish because look at reverse repos. There's $500 billion in reverse repos right now, meaning that there is demand for treasuries that do not exist, or rather treasuries that are not in the open market. These are banks coming to the Fed with $500 billion and saying, hey, we want some of those treasuries on your balance sheet that you've been buying through QE. We want some of those for a while. And here's $5 trillion. Give us $5 trillion in treasuries to hang on to overnight. And so you might say, well, if the Fed tapers, there's $500 billion right there in demand for treasuries that will just get sapped up with having no net effect on yields. And that's true at the moment, but that's because the Fed has continued QE at the same pace ever since Janet Yellen made the decision to begin drawing down the Treasury General account, which I talked about a couple months ago. In fact, I talked about it quite a few months ago, back when Trump was president, when they were building up the TGA, because it got up to be about $1 trillion. And Janet Yellen has decided to start, this is for those who don't know, the U.S. Treasury's checking account. They've had a lot of money in their checking account, and so Janet Yellen decided to just start spending money out of that account rather than issuing debt. But of course, once she draws down the Treasury, general account to wherever it is she decides to draw it down to, she will have to begin issuing Treasury bonds to pay for all that spending that was being paid for out of the account, because that money is not being replenished. It's not like their balance is staying the same and they're spending what's coming in, but that's kind of how it looks right now, because they're not issuing as much debt relative to how much money is being spent by the federal government this year. But once that comes to an end, which it will, because the Treasury General account is finite, and so they have to start issuing more debt if they're going to keep spending like this, which they will. Deficits don't shrink. Federal government deficits get bigger every year. That's just a general rule. And so at that point in time, you're going to have the federal government issuing more bonds. At the same time, potentially, that the Federal Reserve is tapering bond purchases. And I don't see how that doesn't result in a rise in yields, especially since treasuries are yielding so low right now. I don't know how they can get much lower. The 10-year was in the 1.4s, and today it's broken above 1.5%, where yields currently sitting at 1.574%. That is up 7.5 basis points today, as a result of the Fed's announcements, which I think it is appropriate for yields to begin rising if the Fed has now talked about talking about tapering. If tapering is going to come at the same time in which you see the Treasury General account finally being drawn down, and the federal government having to issue more and more treasuries, yes, I think that reverse repo at that point is going to no longer be an issue that people have to talk about. And who knows, I might have to eat crow on this, but I'm looking at right now $500 billion in reverse repos. Well, after a few months of tapering and more debt being issued by the Treasury than we've seen over this past year, I don't know why people would still be using reverse repos at that point. So that's the next frontier in those of us who like to monitor Fed policy. It will be watching how the jawboning, the taper talk, which the taper talk will be intense for a long time before tapering actually begins. And then ultimately, if they get this far, the tapering itself, how that is going to affect yields. Because again, if this leads to now an upward trend in yields, at least maybe a short to medium term, short term, I guess, wouldn't be a big problem, because if it's only short term, that means that the Fed is able to reverse course fairly quickly once equities correct, which they likely are going to do. In fact, I think Bank of America had a line out earlier this week that's essentially saying that everybody knows that once the S&P corrects 10%, the Fed's tapering will be over, finito. Which is indeed the case. So, who knows? Maybe we'll be stuck in this forever. Maybe the Fed will be able to quit tapering back then, or at that point, and the bubble will not pop. I'm not going to claim to know everything. This whole charade has gone on for years longer than I and many other people would have thought it could. The Fed has done a remarkable job supporting asset prices, and they intend on continuing that in perpetuity, forever. But of course, there's also the matter of consumption of the consumer, which, as Powell kept pointing out today, people are not getting back to work, and that is a problem. And it shows you that all this consumption, all of this so-called economic activity that we witnessed over the past few months has been largely the result of stimmies rather than reopening. Sure, part of it's reopening, but the reopening only went so far. There's still, I think, 8 million people who had jobs before the Wu flu who do not have jobs now. That is not a sign of an economy which has recovered. But there are more job openings than there are people looking for work. So it's not like there aren't jobs available. It's that these 8 million people don't want to go back to work. And so that would seem to indicate that production is not going to catch back up with where it was pre-Wu flu. And consumption now is only being supported through government spending. So if the stimmies stop flowing, well, then you're going to have a whole separate issue from rising interest rates. Sure, the Fed will be able to keep suppressing interest rates by buying bonds if they refuse to taper or perhaps even increase QE. But the irony is that there will be pressure on the Fed to taper or to increase rates in order to fight inflation. And so all I see on the table here are bad options moving forward. I see a deceleration in our phony economic recovery, which is purely based on stimmies. That is, if the government does not issue more stimmies. If the government does issue more stimmies, I see more inflation, which is unfortunate. Please excuse the background noise, I'm almost done, but there will be inflation, of course. I don't think I need to go over why inflation's a bad thing, so I'll skip over that. But if the Fed chooses to fight that inflation, then we, again, are going to have a problem of pricking the bubble on our hands, because that will mean higher rates, higher bond yields, and deflating asset prices. So your choices are declining consumption in the real economy as a result of the lack of artificial support for consumption, i.e. stimmies. You have inflation of consumer prices, or you have deflation of asset prices. All of these are bad places to go for the economy. So, with that said, I will leave things off there for today.